Picture this. You finally decide to take control of your finances. You start saving money, tucking away $100 or $200 each month. It feels responsible, disciplined, and mature. But then, one day, you check your banking app and notice something unsettling. Your savings account has $10,000 sitting there, earning a meager interest rate of perhaps 0.5%. After a full year, you have only earned $50 in interest. Meanwhile, you keep hearing buzzwords like stocks, index funds, and compound growth. You start to wonder, am I doing this wrong? While saving is a crucial habit, saving alone rarely builds significant wealth. This is where many people get stuck. They understand the importance of saving, but feel lost when it comes to transitioning into investing. In this video, we will break down the exact step-by-step path to shift from saving to investing without feeling overwhelmed or jeopardizing your financial security. Saving money is essential, but it is not the ultimate goal. It is merely the first stage of a larger financial strategy. Think of it this way. Savings are designed to protect your money, while investments are designed to grow it. These are two distinct functions. Consider the math. If you keep $10,000 in a standard savings account earning 1% interest, you end up with $10,100 after 1 year. However, if you invest that same amount in the S&P 500, which has historically returned an average of about 10% annually, you would have $11,000. While that difference might seem modest initially, the real magic lies in compounding over time. After 20 years, your 1% savings account would grow to about $12,200, whereas investing at a 10% return would result in approximately $67,000. The starting capital is identical, but the outcomes are vastly different. The primary wealth gap in our society is not necessarily between those who save and those who spend, but between those who save and those who invest. The barrier to entry is rarely mathematical, it is psychological. Saving feels secure and predictable, whereas investing feels volatile. When your money is in a savings account, it remains static. Investments, however, fluctuate daily. This emotional volatility can be intimidating, but you do not have to put your savings at risk all at once. The transition should be a gradual, staged process. Your first step is to build a robust emergency fund. Before you invest a single dollar, you should have 3 to 6 months of living expenses set aside in cash. This is not for investment opportunities. It's your safety net for unexpected events like medical emergencies, car repairs, or job loss. An emergency fund protects your investments from the unpredictability of life, preventing you from having to panic sell during a market downturn. Second, separate your finances into two distinct mental buckets, safety money and growth money. Safety money stays in your savings and remains untouched. Growth money is allocated to investments, where it is allowed to fluctuate for the sake of long-term appreciation. This psychological separation significantly reduces anxiety. Third, start small.
You do not need thousands of dollars to begin. Many brokerage platforms allow you to start with as little as $50 or $100. At this stage, the goal is not massive returns, but building the habit of consistency. Fourth, keep your investment strategy simple. Beginners often make the mistake of jumping into complex day trading or speculative assets. Instead, focus on low-cost index funds. These funds track the overall stock market, allowing you to invest in hundreds of companies simultaneously. This provides immediate diversification, lower risk, and long-term growth. It is a simple, effective strategy endorsed by legendary investors like Warren Buffett. The most powerful strategy in investing is remarkably boring: consistency. If you invest $300 per month into the market with an 8% average annual return, after 25 years, you would have roughly $285,000. Even though you only contributed $90,000 of your own money, the remaining nearly $200,000 comes from the power of compounding. Of course, the market will have its ups and downs. News headlines can be dramatic, and it is easy to panic. This is where discipline separates the investor from the gambler. Think of saving as storing seeds in a jar. They are safe, but they cannot grow. Investing is like planting those seeds in the soil. It may look messy at first and show no immediate results, but over time, they grow into something far greater. Even if the market experiences a downturn, long-term investors often benefit. When prices drop, your monthly contributions buy more shares at a lower cost, which can lead to stronger returns when the market recovers. Experienced investors stay calm because they think in terms of decades, not days. To summarize, build your emergency fund, separate your safety and growth money, start investing small amounts consistently, focus on simple index funds, and stay disciplined. Saving provides you with stability, but investing provides you with freedom. The sooner you combine both, the more powerful your financial future becomes. Are you currently in the saving stage, or have you already begun your investment journey? Let me know in the comments. Once you make the transition, your money truly begins to work for you.